So hello everyone, welcome to EduTap and welcome to today's Finance 360-degree session. So today we are going to discuss the new notification of the Reserve Bank of India, the new direction of the Reserve Bank of India, that is the Reserve Bank of India Investment in Alternative Investment Fund Directions 2025. Now this is very important as it is also mentioned in various news articles, and you can directly expect the objective question from these directions in the phase 1 as well as in the phase 2 of the examination. Okay, so these directions are very important that we are going to discuss today, and we are going to have the clarity about the data points mentioned in the directions, as well as we will have the holistic coverage of this direction. Okay, but before that, there is a surprise for all of you. EduTap has brought for you the never before offers. This is only available for a limited time, valid from 1st August till 3rd August. And here, if you are thinking of purchasing the courses, or you are thinking that okay, the examinations are coming near and I want to get a systematic course through which I can prepare well for the examination, then EduTap's courses are provided for you. Here you can see that for RBI grade B, IFSC grade A, SEBI grade A, IRDI grade A, NABARD grade A, PFRD grade A, for the regulatory bodies courses, there is flat 74% off that is going on, and you can use the code 1time74 to get the best possible offer. Okay, and if you are thinking to buy the course, so this is the best time to buy the course, as this is the never before offer that is brought for you all. Okay, as well as in the other domains also there are the never before offers that is going on. So if you want to purchase the course for EPFO or for the banking exam, so here you can see the offers. Okay, as well as if you want to know more about the courses, you can call us here also. And if you are thinking of purchasing the systematic crisp course, this is the best time for you all to get the course at a feasible price. Okay, now moving forward, coming to the Reserve Bank of India Investment in AIF Directions 2025. So Reserve Bank had issued circulars in December 2023 and March 2024. These are the existing circulars that prescribe the regulatory guidelines in respect to the investment the regulated entities under the Reserve Bank of India do for the alternative investment fund. So the regulated entities, they have to follow certain regulatory guidelines when they invest in the alternative investment fund. Okay, now what is alternative investment fund? So alternative investment fund, or AIF, means any fund that is established or incorporated in India, which is a privately pooled investment vehicle which collects funds from sophisticated investors. So you must have heard about the mutual funds, which collects the money from the retail investors like you and me and from the other investors. Now the collected funds are invested in the different securities, in the different instruments. Okay, so this is the idea about the mutual funds. Similarly, the alternative investment fund, they collect the money or they pool in the funds from the sophisticated investors, from the big investors, from the financial institutions, from the institutional investors. And the alternative investment fund, they collect the money, they pool the funds from the sophisticated investors, whether Indian or foreign, for investing the funds in accordance with a defined investment policy for the benefit of the investors. Okay, so alternative investment fund, they collect the money, they pool in the money from the sophisticated investors, and then this money is invested in the different securities or instruments as per the defined investment policy of the alternative investment fund. Okay, so this is the idea about the AIF. Now various regulated entities under the RBI, they can invest in the alternative investment fund as per the regulatory guidelines. Now RBI has reviewed these guidelines, taking into account the industry feedback as well as the regulations issued by the SEBI recently relating to specific due diligence of the investors and investment of the alternative investment funds. Now, accordingly, in an exercise of the powers that the RBI has got from the Banking Regulation Act and the Reserve Bank of India Act and National Housing Bank Act, the Reserve Bank of India has been satisfied that it is necessary and required in the public interest to bring the new directions. So the RBI has released these new directions, that is the Reserve Bank of India Investment in AIF Directions 2025. Okay, so after the review, the RBI has released these new directions. Now these new directions, they will be called Reserve Bank of India Investment in AIF Directions 2025. These directions shall come into force from January 1, 2026 or from any earlier date as decided by the internal policy of the regulated entity. So RBI has said that by January 1, 2026, all the regulated entities shall start following the new directions. But if a regulated entity want, they can start following the new directions from an earlier date also, but not later than Jan 1, 2026. This is the idea. Okay. Now applicability. So these directions shall be applicable for the investment in the alternative investment fund for all the regulated entities, that is commercial banks including small finance banks, local area banks, regional rural banks, primary urban cooperative banks, state cooperative banks, central cooperative banks, all India financial institutions, and non. This is the idea. So now coming to the definitions. Okay. So first of all, let's understand about the debtor company. So basically, let's say that XYZ bank, that is a regulated entity, is providing the loan to the ABC company. Okay, or the XYZ bank through a debt instrument is providing money to the ABC company, the debt of 50 crores. So a debtor company of a regulated entity shall imply any company to which the regulated entity currently has or previously had a loan or investment exposure, that is the debt instrument, or the debt has been provided through the debt instrument by the regulated entity to the company anytime during the preceding 12 months. So now the debtor company is the company that has taken the loan from the bank or has taken the money from the bank through the debt instrument, excluding the equity instrument. If the bank is investing in the shares of the company, so this is not considered as the debt, right? So that's why this excluding equity instrument it is written. So here, if the bank is investing in the shares of the company, this is not considered under the debt prospect. This is the idea. So if a XYZ company, if the XYZ bank is providing loan or is providing debt through the debt instrument to the ABC company within, like during the preceding 12 months, so it is considered that the ABC company is the debtor company. Now like we have discussed in the previous sessions about the downstream investment. Okay, so what is a downstream investment? So basically, let's say the ABC company is saying that we have returned 30 crores but we are not able to return 20 crores. Now we have returned the 30 crores with the interest payments, but now we are not able to return the 20 crores. Now the XYZ bank is afraid that if the ABC company do not return the 20 crores, this will become the NPA, and the bank will have to maintain provisions against this NPA, as well as this will be bad for the bank because it will have the higher NPAs. So now the bank is thinking that the bank can provide further loan to the ABC company to cover the previous loan so that the ABC company can return the previous loan. But the bank know that the RBI do not allow this kind of further loans. So XYZ bank is investing in the alternative investment fund. So this bank is investing in the alternative investment fund, and the alternative investment fund is providing the money to the ABC company through the debt instrument. So the XYZ bank has invested in the alternative investment fund and has said that provide the 20 crores to the ABC company through the debt instrument by the AIF. So the 20 crore, the ABC company has got the 20 crore to return to the XYZ bank. So the XYZ bank will not get this NPA or will not have to maintain the provisions. Now this, what has happened, this is the downstream investment. This is the downstream investment where the XYZ bank is providing the funds to the alternative investment fund, or where the XYZ bank is investing in the alternative investment fund so that the alternative investment fund can provide the debt to its debtor company, so that the debtor company can return the earlier money of the XYZ bank. So this is known as downstream investment. This is done usually by the regulated entities to cover up the previous situation, to cover up the NPA situation, and this was identified by the RBI. That's why the RBI has brought restrictions on the downstream investment. Okay, so XYZ bank, if they are doing investment in the alternative investment fund and the alternative investment fund is providing the money to the debtor company of the XYZ bank through the debt instrument, so that is limited. Okay, so there are limitations on that is imposed by the RBI. Okay, now equity instrument, it is allowed if the XYZ bank is investing in the alternative investment fund and alternative investment fund is investing in the shares of the company, so that is allowed. There is no problem in that because the shares are involved and the market valuation is involved. Okay, so equity investment is allowed, but this kind of debt instrument investment is called downstream investment through the AIF and through the bank in the AIF and in the debtor company. So this kind of downstream investment, there are restrictions on that. Okay, so basically if the XYZ bank has a debtor company, ABC company, and the XYZ bank is investing in the AIF so that the AIF can provide the debt to the debtor company of the XYZ bank in the form of debt instrument. So this kind of downstream investment, this is the downstream investment that is restricted to an extent, okay, but the equity investment is allowed. Now, general requirement: a regulated entity's investment policy shall have suitable provisions governing its investment in an AIF scheme compliant with the existing law and regulations. So the regulated entity should have a proper investment policy that should be suitable, that should have suitable provisions regarding the investment that the regulated entity is doing in the AIF scheme, complying with the regulations and the laws of the RBI. Now, limits on investment and provisioning. So basically, no regulated entity shall individually contribute more than 10% of the corpus of an AIF scheme. So basically, if the corpus of the AIF scheme is 100 crores, so a single regulated entity individually cannot contribute more than 10%. That means a single regulated entity individually cannot contribute more than 10 crores. This is the idea. Okay. Collective contribution by all the regulated entities under the Reserve Bank of India, whether it is a bank, whether it is a NBFC. So collective contribution by the regulated entity in an AIF scheme shall not be more than 20% of the corpus of that scheme. So this is the idea. Okay. Now, if a regulated entity contributes more than 5% of the corpus of an AIF scheme, so if a regulated entity is contributing more than 5% of the corpus of the AIF scheme, which also has downstream investment. Downstream investment basically means that the XYZ is providing the investment to the alternative investment fund. So this regulated entity, that is, let's say a bank, is providing investment in the alternative investment fund, and this alternative investment fund is providing the investment in the debtor company of the regulated entity through the debt instrument. So if this kind of downstream investment is happening, so if a regulated entity contribute more than 5% of the corpus of an AIF scheme, which also has downstream investment in a debtor company of the regulated entity, then the regulated entity shall be required to make 100% of the provisions to the extent of its proportionate investment in the debtor company through the AIF. So basically, the regulated entity that has invested in the AIF and the proportion of the investment that is going to the AIF, that is going to the debtor company, so 100% of the provision has to be maintained by the bank for the downstream investment. Okay, so let's say XYZ bank has invested 10 crores in the AIF, out of which 5 crores is going to the debtor company through the debt instrument. So 100% of the provisions have to be maintained for the downstream investment that is happening through the AIF to the debtor company. Okay, so basically, if a regulated entity contribute more than 5% of the corpus of an AIF scheme, which also has downstream investment in a debtor company of the regulated entity, then the regulated entity shall be required to make 100% of the provision to the extent of its proportionate investment in the debtor company. So whatever investment has happened through the AIF in the debtor company, that is the downstream investment, that is through the debt instrument. So 100% of provisions have to be kept for that. Okay, subject to a maximum of the direct loan or the investment exposure of the regulated entity to the debtor company. Okay, so this is the basic idea. Now, notwithstanding, so in spite of the provision of the above paragraph, if a regulated entity is contributing in the junior units, in the subordinated units of the alternative investment fund, so junior units have more risk and they have more returns also. So basically, if the regulated entity is contributing, is investing in the subordinated units of the alternative investment fund that have more risk and more returns, so this kind of investment shall be excluded from the capital funds or has to be deducted from the capital funds of the regulated entity. So if the regulated entity is investing in the junior units with high risk and high returns, so regulated entity shall deduct the entire investment in the subordinated units from its capital funds proportionately from both tier 1 capital and tier 2 capital of the bank, of the regulated entity. Okay, the last point or the last few points are the exemptions. So only the basic idea here is required. So if the regulated entity is investing more than these limits, let's say the regulated entity is permitted by the Reserve Bank of India previously to invest, and the regulated entity is investing in the alternative investment fund more than these limits. So as these allowance was given by the RBI previously, so they will be continued. So outstanding investment or commitment of a regulated entity to the alternative investment fund made with prior approval from the Reserve Bank under the provisions are excluded from the scope of paragraph 6A and 6B. So basically, the investment or commitment that the regulated entity is having in the alternative investment fund with the prior approval of the Reserve Bank of India, they will be excluded from these limitations. So if the RBI has allowed the regulated entity to have more investment in the alternative investment fund, so that will be allowed. Okay, that will be continued. Reserve Bank may, in consultation with the Government of India, exempt certain AIFs from the scope of the directions. Okay, so certain alternative investment funds, they will be exempted from these regulations with the prior approval of the RBI in consultation with the Government of India. Repeal provisions, so these earlier provisions have been repealed, and from 1st January 2026 all the regulated entities will have to follow the new directions. Okay, now outstanding investment by the regulated entity that is done, so the investment that is done by the regulated entity before the release of the new directions, so they will follow the earlier directions. Okay, in respect of any investment that is made after the new directions are released, so after the new directions are released, so whatever investment is made by the regulated entity in the AIF, they have the opportunity, so the regulated entity, they have the choice to continue with the existing circulars, the earlier circulars we can say, or the revised directions till the 1st January 2026. Let's say from August till December, whatever investment the regulated entities are doing in the AIFs, they can choose to follow the existing circulars or the new directions. But from 1st January 2026, they have to compulsorily choose the new directions. They have to compulsorily follow the new directions, the revised directions. So I hope it is very much clear. If there is any confusion, you can write in the comment section below. Now let's see the first question. So this is the first question where you have to tell that which of the following statements is or are correct in regards to the limits on the investment and provisioning by the regulated entity in an AIF scheme. So you have to tell the correct statement here. Okay. Coming to the next question, that is in regards to the collective contribution by all the regulated entities in any AIF scheme shall not be more than what % of the corpus of that scheme. Now again here, if you do not know about the code, again I am explaining it that it is 1 times 74. So this is a never before offer, and this is a very good opportunity for all of you to get a systematic crisp course in a feasible price. And if you want to buy the regulatory body courses, so you can get it at flat 74% off. And as the examination is coming near, so many of you might want to prepare with the course and you might want to prepare with the systematic material. So this is the best offer. This is the best time for you to get the course. Okay, so thank you everyone. I hope this is very much clear, and if you want the PDF of the session, you can get it in the Telegram channel of EduTap, and the link for the Telegram channel is provided in the description box below. So thank you everyone. Thank you for joining.